We've seen a better phase for emerging markets for sure in share price terms. Much of that is about the pressure that was applied to emerging markets from a whole series of big macro factors easing off. The strength of the US dollar puts pressure on emerging markets, and we've seen the US dollar stabilize somewhat. With a stabilizing US dollar, we've seen an improvement in commodity prices, and many emerging markets are quite strongly related to commodity prices because they produce oil or iron ore or the like. And so we have seen some relief. Because markets are sort of forward-looking, they take the range of potential outcomes and they price that in. And we got to a point where the market was very anti-emerging markets, very underweight emerging markets, and expecting the continued pressure just to get worse and worse. Possibly there was some expecting things like the Chinese currency, the RMB, to devalue. And most of those worst fears haven't occurred, and that's been some relief. What we haven't really yet seen is much improvement in the fundamentals for companies and economies in emerging markets that we can invest in. You've seen essentially the ratings on those emerging market companies rise back up towards their medium-term averages, but we haven't seen the fundamentals improve. And until we do see those fundamentals improve, it's unlikely that we'll truly say that we've seen the turn in emerging markets. Certainly a very significant risk. We have, in many parts of the world, essentially a contamination between politics and economics. So central banks becoming increasingly less independent. So if you think about the things that are happening in Japan, the role of the Japanese government and the Bank of Japan are entirely intertwined through Abenomics. China, as a much bigger player on the global stage now, is a very political economy, and everything that happens within China in some form happens politically. The US election, and one of the concerns about the US election, if we get one of the fringe candidates come through and Hillary Clinton doesn't win the election, there's a possibility of some encroachment on the things the Federal Reserve does. Less of a risk here in the UK, but amongst those big parts of the global financial system, there is a political impact. Many years ago, it was talked that we had a situation where you had an invisible hand in markets, and that's what drove markets, was really economies. Today, that hand is much more visible. It's the hand of the electorate, it's the hand increasingly of central banks, and whether quantitative easing, interest rates, foreign exchange parity and so on is the real driver of markets at the macro level. What I would say, as far as Brunner's concerned, we really are investing in companies. It's about stock picking. It's not about guessing the next change in what happens in the macro economy. We have to be very aware of the framework within which we invest and which companies we buy. But for us, it's really about the companies that we can invest in and the fundamentals of those companies. Yeah, the US election year, we have the US election in November, is rarely a good year for the healthcare sector. Healthcare spending in the US is an enormous proportion of GDP, and the prices they pay for their healthcare are very high, and it's always a political topic, and it's becoming an ever bigger political topic. Hillary Clinton very much driving the debate there, as she did during her own husband's presidency as well. And we've seen ever greater concerns on the pricing of pharmaceuticals within that sector. As we get through the year, that's unlikely to change very much as time goes by. The possibility, in fact, is that it gets worse. If the swing away from Trump, if Trump indeed is the Republican candidate, is the possibility we end up with a Congress which is more overwhelmingly Democrat than we previously had under President Obama. And that would allow for more healthcare reform and possibly greater pricing pressure. What we've done within the healthcare stocks, which have performed very well, and our stock selection in Brunner has been really excellent actually in healthcare. We've made lots of money in healthcare over the last 3 or 4 years, is ease off our weightings and become more defensive. More and more of the investment now is into things that facilitate, things like health insurance, it's things like dialysis treatment, the things that aren't really subject to pricing pressure. And we've reduced some weightings in things like Celgene, sold Allergan, sold UCB. So the weighting in the sector has come down and our risk profile in the sector is down. And we think it's too early to change that materially. Clearly, as we get towards November and we get a better view on what happens thereafter, the opportunities will abound. Very long term, we're actually very excited about this sector still. Huge leaps now being taken in terms of the science, things like immunology, survivor rates in cancer, much, much better. So we still see the long-term future of the sector as strong. Pricing is the risk. We have a lot less in the UK now. I was looking at this only yesterday, at where we were long-term historically. And it wasn't until 1980 that Brunner started to invest overseas. We've now got to the point where the UK is only about 40% of our investment in the whole of the portfolio. And that's been a steady trend that's happened over the course of the decades. We moved from about 50% in the UK to 40%, not necessarily about Brexit, although we did have some concerns that sterling would be a little bit weaker. And clearly, the more that you've got invested in sterling, the more that impacts your total return, translated back into sterling. We have more overseas, that's been helpful. And Brexit is a small factor. Now that we're down at sort of 40% in the UK, and we are starting to see some fears around the possible outcomes of Brexit in certain sectors, let's say the banks, let's say consumer discretionary stocks, retailers and hotel companies in the UK, we're starting to look at opportunities. Too early. The lesson from the Scottish referendum was to buy quite late. The stocks have an increasing resistance to fear as they go through towards that final date, and it feels too soon to do very much in the portfolio as a sort of anti-exit trade, if you like.